Boy, good thing we don't have to wear those suits and like blazers every time we go into the office, right, man?
It does feel good. I was just thinking about that. It's funny you actually say it because my wife Nikki and I, we actually just looked at a house earlier today,
Yeah.
and I've shared with you kind of our struggles in finding a new home, and
People are responding to it, man. Like I love how
it,
transparent you're being. You just moved to Boston. He's from up here. He's moving closer to his wife's parents, and like you got caught up big time in a real estate storm.
yeah, and it's funny. You have to pick and choose kind of what you're good with because you're not going to find the perfect house either doesn't exist or you can't afford it, right? And so we're looking at a house today, and one of the biggest downsides. I don't even know if hopefully none of the the selling agents are looking at this for negotiation tactics. But one of the biggest downsides were the size of the closets. It's an older home. Closet space not that good. And I'm like, Nick, like honestly, I'm like, because I got a closet of all my suits and shirts and everything from kind of being more out in the public and I don't want to say my old life, but it was the same industry, same world, but wore suits more often. And it was funny. I'm like, I don't really need a ton of closet space anymore. I'm like, I usually wear, long sleeve shirts now. I'm not wearing the suit every day. I go, we could kind of put some of that stuff in storage and throw it up in the attic or the basement. So maybe we can get by with the smaller closet. It was definitely something we're considering. But hey, the flexibility we have now, we can get by with that.
It's so funny. I mean, I haven't had a real job in a long time, and it gets to the point where I don't know if you're into clothes. Like I'm not. I personally don't care. Like I just don't buy clothes. My wife's like, you gotta start. You gotta go beyond like an Under Armour, golf shirt and the same pair of jeans. I probably got four pair of jeans that are presentable. Anyway, welcome to the Thursday New Age Wealth Advisors live stream, yet to be renamed. This is my partner in peril. If anybody has a house within 2 miles of Boston that you'd like to sell my partner, please give him a call. I'm joking. So Ryan Bouchey out of Boston, Todd Gordon here in Saratoga Springs. This is the New Age Wealth live stream. We're doing this every Thursday in the market close. Get you guys updated on what we're seeing in the markets. Take your questions, comments, insults, anything you got. We're going to share with you everything from portfolio management, what we're seeing, how we're positioning our clients' accounts, themes, trends we're seeing in the market, things we're looking ahead, interpreting all the events that are happening. There's so many cross currents happening in this market right now. I feel like once a week is not enough to do this, so we could talk about that. We'll take you on the other end in terms of financial planning, tax strategy. Here we are at the quarter end. It's 3/31, Q1 of 22. Whoosh, out. Can't believe it was that fast. We have taxes in the U.S. coming up here. We have a deadline in 2 weeks. So we're going to talk a little bit about that. But, let's just kind of do a market rundown here real quick. We'll pull this over here. Desktop. Of course, it doesn't want to show. Uh, 1 second, folks. 1 sec.
As you're pulling that up, I'm going to jump in quick. But
Yeah, go
yeah,
ahead,
it's amazing
please.
we're already at the end of Q1 for a number of reasons. But my God, like if you could kind of go back to the start of the year, and whether it was December just prior to January, and just kind of say everything that we've kind of seen these last 3 months, and when you look at the S&P, what's it off 4% year to date? Maybe not even. I think I looked earlier today, it was like down
Yeah,
3.75 or
I'll give you the
so.
number. It's going to be less than five. Price range percent
Yeah, it's less than.
from all time. We closed a little lower, so it's 5.57 off the highs right now. All time
Is it
highs.
that much?
Yep.
Okay.
Yep.
Okay. Well, from all-time highs, but even so, that it's right around that for year to date as well. I think the highs were reached right at the end of December. But my God, if you said what we saw with inflation rates, what the Fed and what interest rates have done, I'm pulling it up in front of me now, just how
Yeah.
much the 10-year has gone up in the last 3 months. war, one of the biggest nuclear powers in the country going to war with their neighbor. Everything that we've seen so far these last 3 months, and to be down 4 or 5% in the S&P is
It
pretty
shows.
astonishing, frankly.
Yeah, I mean, you've got you've got geopolitical pressure. Obviously, we've got Russia-Ukraine war, and then a lot of interested parties watching the progress of this. You've got inflationary pressures, and you've got a pandemic that we're still in, and the fact that the market
Yeah, true.
has handled it so well gives you it should give you pause when you hear so much bearishness out there, particularly around the inflation picture, around what the yield curve is doing. We're coming up on earnings. I think financials are going to start probably about the 13th or 14th of April. So we're coming into earnings season. At the end of the day, it comes down to that. Companies are still making money. People are still spending. The consumer is holding up fairly well here as prices are going up. And that's because you said it earlier. They have good balance sheets. People reduce after the credit crisis. The savings rates went up. People paid off high percent credit cards. They got their financial houses in order, and they can weather some price increases. It's been pretty impressive.
No doubt, no doubt. And I was kind of looking at just some charts too of some of the leaders. I mean, probably some of the leaders, because I think that's what you had up to, or no, that's
Yeah. So
more the major indices. But
yeah,
even
this is the
when you look at the
S&P.
leaders, yeah,
Yep.
the
Go ahead.
leaders sort of fall in line with probably what you would expect. And in terms of, I mean, energy's been, I mean, that's the one outlier, right? And that was an outlier before everything happened in Ukraine and Russia, and that only kind of led to an uptick in what oil prices are doing. And obviously, some of those companies are so dependent on the price of oil in terms of, or correlated with the price of oil. But even before that, in frankly, I think going back to kind of the roots of economics, supply and demand, and seeing the bounce back of these energy companies. But they've been the one major outlier. But most indices outside of energy on the upside, and maybe tech a little bit, and communications on the downside. But most of the different sectors have been relatively flat so far year to date.
Yeah.
But you kind of see some outliers with based on kind of what we're seeing in interest rates. Utilities have been doing well. Um, some other areas of the market.
So it's you don't even realize so we like to gauge sector rotation using this tool, relative rotation, that is put out by a tool called Optima, and you can benchmark this around the S&P. And what I'm going to show you the energy comeback has been absolutely amazing. Okay, so basically the skinny on this is if you're in the top right hand quadrant, you're showing more momentum and relative strength, price outperformance compared to some central benchmark, which is the intersection here of the XY axis, which is the S&P. Crude oil, energy stocks, I should say, each dot is 1 month. Okay, and if you go back, and I could go back and pull in some more time here. Let me go to the last 5 years. It's going to take a second to do that. Energy being so far down here in the bottom left, it was massively underperforming where the S&P was. And on a month-over-month basis, like we were way down here. I got to bring more time in. This goes back to June of 21, but we were way down here in 2020 and 19. On a month-over-month basis, again, relative to the S&P, it's just moved into the leading quadrant, which is interesting because here's XLK, which is your technology ETF. It was firmly up here leading through 2017, 18, 19, into 20, a little bit of the COVID rally, but energy is falling out of favor here. Technology, XLK is falling out of favor. And I'm very much watching where this XLE goes, these energies. It could actually, on a month-over-month basis, overtake technology on a relative strength basis. I don't think it's going to happen because what we're starting to see, this is a cool little tool we use, you're starting to see a little bit of a hook just in the last 2 months in technology. And what we're saying is value stocks like energy and financials and materials and industrials have been outperforming the tech stocks, and specifically the high-flying pandemic stocks like Zoom and Peloton and all these names. But the companies that are making money in tech are starting to come back here just over the last 2 months. And if we get out of the monthly and go down to a week-over-week basis, this is going to change the scales. You can see energy's been cruising, but all of a sudden we're starting to head back down. And technology is starting to do the hook. So it'll start on the weekly, then go up to the monthly. So we're starting to see signs that growth, specifically tech, is starting to overtake. And that is so far apart from what anybody was talking about 2 weeks ago, as everyone was saying yield curve inversion, recession's coming. Don't even think about a stock market coming back, let alone tech stocks rallying and leading us back. I think it's quite amazing. And it goes back to the yield curve discussion. So many people were focused on recession just because of what the 210 was doing, but there's so much more to the story. Where do you want to take this discussion? I know I threw a lot at you.
Yeah, I'll kind of tackle it a little bit of my perspective on like probably the higher level, more big picture, and you may
Please.
come back to me with some more kind of technical analysis on it.
Yeah,
And it was great kind of watching that sort of rotation between energy and technology. But to me, a little bit when I think of technology right now, and especially kind of as we got to the end of 2021 and entering 2022. I mean, we've talked about this. This isn't a new topic, but you see a lot of those winners from COVID, right? The companies that just shot to the moon last year, you kind of saw them pulling back last year, and even some of the bigger companies as the inflation numbers became greater and greater. Some of the fears with regard to interest rate hikes and the Fed. I mean, in just kind of as you price companies for the future, I mean, these growth companies are so much of their price is because of the future expectations, and as you bring in a higher inflation number, that just brings down their present value a little bit. I mean, just from a pure mathematical valuation of companies, and it almost felt like in you saw Nasdaq was, I don't know if it hit technical bear market territory of being down 20%. I think it was down 20% maybe intraday at one point. But
I've got it up right in front of you. So
yeah,
max
probably got pretty close. If it didn't hit 20, it was just about 20%.
Yeah, we hit
Yeah, it got
22%, double
yeah,
bottomed, and then we've come back. And what's interesting is this orange line is the 200-day moving average, and a lot of
yep,
people like to follow the 200-day. It's kind of an arbitrary number if you think about it, because there's 252 business days in the year. I feel like you should watch the 252 period moving
yeah,
average,
that's a good
but
point.
whatever. But please keep going.
It just sort of felt from, again, just from a higher perspective, it felt like a healthy reset from where they were, right?
Yeah.
Because it just kind of felt like the market was just getting a little bit ahead of its skis. Especially the leaders of technology, the largest companies that make up so much of our everyday life. They're still, it's a different sort of technology sector, different kind of growth companies than we saw 10, 15, 20 years ago, where they're making really good money. They're almost in some ways, I don't want to say fully recession proof, but when you think about how they've diversified their offerings in terms of an Apple, Apple can almost be looked at in some ways as partially a utility company with their Apple Store and everything, that all the
Hmm.
income that comes through there. Amazon has their entirely split off company of the
Web
AWS and
services. Yep.
in,
Yep.
in their services. So these companies are so diversified and they're so strong that you saw the pullback. It felt like a healthy pullback, and as you're kind of seeing when you looked at that graph that you showed for the sector rotational elements and seeing some more strength, it almost felt like the repricing in that pullback was a good thing for these companies. And we've kind of digested some of the fears of interest rate, the fears of inflation, and it's not that surprising to kind of see some elements of strength there after the pullback.
Yeah, yeah, and this is why I like I'm now a portfolio manager rather than a trader. I'll always look at the charts, and Ryan, I think you're cool with that at this point in our business partnership. But just for me, it's the ultimate kind of emotion. It's the emotional, I don't know, throttle, I should say. It's just when people, you get so caught up in all the news. I mean, everything we heard over the last 2 weeks, I mean, good God, man, like you not only want to sell all your stocks, but you want to go short the market somehow. But then when you step back and you say, all right, let's look at a weekly chart of Apple. That's what we're talking about right there. Like that was the pullback we just saw in Apple. Here's the S&P on the same time frame. You look at how far the market has come. I mean, it's like, okay, a little bit more of a deeper pullback there in the S&P, but you look at how far the market's come. It's just so important to just take a deep breath. You know, when things get crazy, we didn't make any moves in the portfolio. We didn't exit anything. We didn't raise any cash, and we're fully capable of doing so. And clients that we're working with know that if things get super hairy and we go into extended bear market, there are moves we can make. But the market is set back. I mean, it's a much different story when you look at Peloton. You know, you look at where Peloton's come. You look at the history, and this stock only goes back to 2019. I mean, you're up to 150 down to 26. Holy cow. I mean, that thing just got wrecked. You look at DocuSign, just absolutely destroyed from 300 down to 75. And that's the entire chart history of this. The valuations, to your point of view, it was such an emotional, crazy time with the Fed showering the economy with stimulus, both on a monetary and the fiscal side. These valuations, combined with a very emotional market, went huge. So this is the kind of market where you have to know the stocks that you're in. I mean, you can't just be trading and investing in what you've had. I mean, you know, I hate to say it, we're back into this whole GME, GameStop. We're back into this. What's the other one? AMC. You know, just kind of keeping. Yeah. You know, I was kind of keeping an eye on this. Sort of just held resistance here in GME. You know, you just look at some of these stocks. Like, you know, I looked at Coinbase, and we're gonna get back on point here. I was on CNBC the day Coinbase went out. And I'm saying, why is Coinbase going to be the next, I don't know, they called it Apple of crypto. Like, right, I used to work for a brokerage firm when foreign exchange used to be the crypto back in the day. I watched margin compression. I watched the bid-ask spread just go to nothing. And it's such a low barrier to entry. Say, why is Coinbase any different? Why can't a bunch of other crypto exchanges come in and compete? And I said, there's no way on CNBC I'm buying this on the IPO, and all we've done is go lower. And it's the same thing. I was looking at this stock, Robinhood. Like, I understand there's brand loyalty and this is the cool new hip thing, but look at the financials. Look at this chart I mean, what is that a stock you want to buy? You want to buy it because it's cheap? No, you buy it because it's got lousy fundamentals. There's no real barrier from like Goldman coming in and coming up with a cool new platform that can compete with Robinhood. Like, it's just
not only that, but you're seeing all the cool platforms from 5-6 years ago. You know, the robo advisors, if you will. They're all getting bought out by the big broker. You know, was it UBS who bought Betterment not too long ago? Or
it sounds right.
I think that's what it. I think. Yeah, and
no,
you know, these things are, you know, they come out as this kind of these rogue sort of new technology platforms for traders and investors, and they're kind of like the anti big bank or anti big brokerage house, and you know, probably most of their business models are going to eventually be bought out by these larger brokerage houses. It just sort of has happened, and that's kind of been the history of these things. But no, I like being able to. I like how we, and I think clients appreciate it as well, and other, you know, non-clients who are tuning in. But I think it's great being able to bring these different elements of looking at the market, and whether looking at sectors, looking at the overall market, looking at individual securities, but bringing in the technical analysis, because, you know, if you're trading on fundamentals, I mean, it's hard to kind of use everything you're looking at and base it entirely on fundamentals when you see some of those major swings, because, you know, everyone says the market's efficient. Well, the market's what the market is. Like, there's no questioning that the market is priced, you know, where it should be based on, you know, supply and demand and what people are willing to pay for a stock or sell it at. But there's no way you see a price move from 75 to 300 without much moving on the under, maybe earnings estimates come down a little bit, or maybe the growth rates aren't as strong. But when you see those wild swings, there's so much more that goes into kind of the analysis. And I think we had a great conversation offline earlier, but just talking about, fundamental analysis, technical analysis, and then just invite investor psyche, right? There's so much behavioral elements that come into play too, whether you're kind of running up in a bull market or coming off of a market peak or hitting the lows. There's so much other things to be considering and to be thinking about when you're making these investment decisions, and that basing it entirely on one area or one sort of basis for your stock hypothesis or your market hypothesis is hard. You can kind of get into some dangerous positions by doing that. So I like bringing the technical aspects into it. It's fun. It's not my background per se, but I've been learning a lot from you, and I think it just adds to the conversation for sure.
I appreciate that, and I think there's, and I know there's a lot. I can't say a majority. I don't even know what percent, but I know a lot of money managers. I know a lot of hedge funds. I know guys who are doing technicals in the closet, but they certainly won't put it out there on the website or on their prospectuses, their offerings, because they're all quant driven and this and that. I mean, I know the guys. I know the technicals are going to the equation in major wealth management operations. So, and it just. And I'm not a technical guy where I'm saying, oh, we're at the 200-day moving average here in ARC. That means what? I don't know. Does that mean buy? Does that mean sell? You can't think in absolutes, whether you're looking at fundamentals or technicals, macro, global macro, intermarket analysis. It's all part of the puzzle that you got to pull together to figure out all the clues that are available to you now. I've been doing technicals my entire life. Like, again, Kathy Wood's flagship fund, ARKK, comes down to the 200-day moving average. And you ask me, what do the technicals say? It's at the 200-day moving average. What does that mean? I don't know. Some say buy it, some say sell it, but it's just part of, what's the sentiment driving the market? What's the theme, or what are people talking about on CNBC? What's the theme driving the market? How is it actually being played out in terms of the four major asset classes, commodities, fixed income, currencies, and equities? What's happening in sector rotation? What's happening with sentiment? Where is the economic data coming in? It's all about how people, the collective masses out there, how they're reacting to whatever the themes that are driving the market. Sometimes they overreact. Markets are usually predictably psychotic. Most of the time they overreact. Very seldom do they underreact. So they're constantly discounting what they think the collective thought process, what's going to happen in the future. Many times they overshoot up and they overshoot on the downside. So you just got to expect the market to be crazy, and especially now as we're getting higher prices. I think the 30-year-olds and the 40-year-olds are making money. The government just stuffed their checking accounts with some stimulus money, but they're coming online. They're trying to buy houses before real estate exploded, but they're starting to exert their influence on this economy, and I think it's pretty awesome. So you got to pull it all together. I mean, and Kathy Wood taking it, and I'll stop right here. Kathy Wood taking a ton of grief here. She has outperformed the market since she's been out. Since she's launched ARC. I mean, life to date, they were up, I don't know, my percentages off here. Right now, she's up, let's see, I got to do it over here. I'll give you this stat, and then I'll turn it back to you here.
Yeah.
Let's see, launched here, she was up since 2015, 715%, give or take. Right now, she's up 250-ish percent. People don't really talk about that. And my point here is, okay, she's off from the top 56%. So she's up 250 since launch. She's down 50%. That's 1/5. She's drawn down 20% from what she's put on. I'm saying, yes, I think there might be a time where some of these high valuation stocks might rotate back in. We're seeing signs of life in DocuSign. Don't think that model is broken. I think Peloton are trying to do a big time, brought in a new CEO. I think they're trying to rebrand. They certainly came off. It's just finding the time when a fundamental thesis, you're starting to see recovery in the numbers, jives with what's happening in the rest of the market. Is it time to get back in there? Peloton's not going to rebuild the story just by itself in a bubble and the stock's going to come ripping back. the whole sentiment is going to shift. We've got to go back into growth and go back into tech and get out of the focus on energy, financials, materials, and industrials. So it all comes together. I don't really know what the point is. I'm saying here, but
I'm gonna tie it up. I got two things. So I want
please,
to talk about absolutes, but I want to finish the thought on ARC and Kathy Wood a little bit,
yeah,
because when you look at that chart and remember, ARC wasn't very well known. It was crushing it. It was crushing it. It was doing so well. It wasn't well known until, I don't know, probably at the start of 2021. So almost about, 6 to 12 months after COVID started, because a lot of the companies that they were investing in did really well through COVID. Again, those exponential growth technology companies, those were the darling of the stock market
yep,
up until towards the end of last year. So she was crushing it before her ARC and Kathy Wood became mainstream. Then all of a sudden it became mainstream, and I think this plays really well into just investor psyche as a whole and our behavioral elements, because she probably got very popular as ARC was kind of peaking. And so I bet if you looked at the flows of ARC, I bet most investors are actually down in ARC. And I think that's where a lot of the
I think
negative
that's fair.
sentiment
Yeah, yeah,
comes into play,
yeah,
because even and this is no fault to the media companies, but again, the media started bringing her up as she started to really grow and the fund got bigger and bigger. And so most investors, and from the time that most observers, investors, you name it, have known about her and her funds, they're probably down and they're not doing as well. But when you
yep.
take it from a long-term basis, and if that's going to be part of your portfolio and you're going to be a long-term investor, it's been a great holding, even with the ups and downs. But I think that's where having that long-term plan and having, the ability to kind of say, what is this piece of the portfolio doing for us? And like I said, if you're diving into ARC because it's up, 200% over a 9-month period, which it probably was close to in the, from the COVID lows, people aren't doing well from that point, and that's where it's down. And I think some of her comments in the public sometimes are, you know, in terms of what she's doing, can be a little tough, and I think she gets a little flack for that. But you got to remember, like, as you pulled up that long-term chart, she's done very well for her
She's very good.
investors that
Yeah,
have been there from the start. But I think
she.
probably the majority of people they're actually probably down from when they've gotten in, and I think that's what you got to keep that in mind a little bit, because
Yeah,
I think that's where a lot of the criticism comes from.
I agree, and I think that's why I think there's, you listen to all the people who get, we have a small audience here, but you listen to the people who grasp a large audience and who are controversial. They're talking about ideas that are going to change the way we live and change the way we interact socially and professionally. Web 3.0, you're talking about the metaverse, you talk about all these things, everyone pontificating about what's going to happen in the future. Kathy's positioning such that, and she's very clear, she said, you need a 5 to 10 year horizon. I believe she's going to be right. I honestly believe. So that's why you have to understand when you're in the market, what is your purpose? And this is when we bring a new client on, is we always ask, like, what purpose does this capital serve? Does this money need to serve you over the next 12 to 24 months? Is this money that we could take a little bit more risk for? You have to understand what this money stands for. And if you have the time frame and you have the capital and you have the risk tolerance to invest in something like that with a timeline that it's going to take 10 years before we are in the metaverse or in virtual reality or have driverless cars. I mean, we're supposed to have 1 million driverless cars on the road, and we're nowhere near that, under a couple thousand, I bet. I think it's going to happen, but you have to have the timeline to do it. So, again, when we launched this portfolio, man, I mean, the fact that we have like 11% energy in our growth and like, I don't know, 15% financials. Like, I still can't believe it, but that's the kind of market you're in. So rather than trading and investing on these big picture ideas that are costing you money in the short term, be invested in what's working now. And that's how we are choosing to attempt to provide our performance relative to what's happening, rather than trading on these big picture ideas or buying companies that they're cheap.
All right, so let me. It's a good point. Let's transition, because we've actually somehow we've already gone about 30 minutes, and I want to talk about, especially because you've put some content out this week about it, and I want to touch upon it. And it led me to think about absolutes, and it feels like the the majority of the public is thinking in absolutes when it comes to this yield inversion curve, right?
Yep.
And we've been talking a few weeks about the inverted because it's been a flattening yield curve. It's inverted, I think. If it's not still inverted, it inverted briefly at some point this week. But a lot of people have been talking about it, right?
Yep.
It's been top of mind of investors, of the public, you name it, and it's been used as historically a recession indicator. And so I think a lot of people are pointing to it and saying, recession is imminent, doom and gloom. I just want to point, you've talked a little bit about it earlier in the week. You have some thoughts on this. So I want to kind of transition from that, thinking in absolutes and saying, hey, yield curve inverted, we're going into recession, versus thinking about it from maybe a bigger picture and maybe bringing some different points of view or maybe different data points into the conversation to really kind of think about how we should be thinking about this right now.
Yeah, no, I appreciate it. And we're reviving this YouTube channel. I left it for a couple years, so it's slow to come back. Those of you who are here now, have you guys heard about us talking about our point on the 10-2 curve? And is anybody else out there tired of listening to the doom and gloom about the 10-2 curve? Let me know your thoughts in there, whether you're watching now or watching the recording. But so 10-2 curve, when it gets down towards the zero mark, generally moves into an inflation. It moves into a recession. So the 10-2 curve down here in purple reaches a low point, and the actual reading right here is negative. You can see the number right here as I scroll my cursor. So right here it got to negative 0.3. So at this point, the two-year yield was above the 10-year yield. And what that means is either the Fed is raising rates so fast to cool down an overheating economy that it's pushing the shorter-term yields up, or there's so much concern in the long term that people are buying long-dated maturities for protection. As that bond price goes up, the longer rates go down. So it's either the Fed raising rates or longer-term Treasury purchases creating an inverted spread. So one of those two things often leads to recession, and recession's in gray here once, here again, and you can see that it bottoms out, we go into recession, bottoms out, you go into recession, and everyone's saying, okay, well, we're bottoming out again, we're coming to a recession. And I'm a follower of Tom Lee. I subscribe to his research, really enjoy it. He was the head of equity analysis at JP Morgan Investment Bank forever, and he's making the point. He's like, okay, yes, right here in 2008 and 2002, there was inverted yield curves on the normal rate as well as the real yield, which is factoring in inflation. When you put inflation into the interest rates, we still had yield curve inversion that foretold a recession here and here. It's not the case here. The real curve, when you factor in inflation, is still very normally sloped. And he was saying, I got to give him credit. He's saying that's why we're seeing PE expansion. We're seeing rotation back into growth because companies can borrow at 3 or 4%, on a corporate loan, but their loan repayments are being inflated away by 7%, so they're actually ahead 4% on the loan. So you've got to factor in inflation. It changes the whole dynamic. And if we go to CPI, guys, we haven't had U.S. Let me go U.S. CPI. Should be year over year. We haven't had any real inflation for probably since the 80s. So we had a little bit of 40 years, man. I mean, that's crazy. So we're seeing a little bit of mean reversion here. And the fact that all of a sudden we haven't seen sustained inflation in 40 years, we're saying, oh, sell tech stocks, sell stocks. We're out of everything. I go the other way and say a little bit of inflation, Fed's normalizing the federal funds rate, getting it up out of emergency status, which was pinned after the global financial crisis. I say it's a good thing, right? I think not a lot of people are talking about it. That we're getting to an economy, a little bit of inflation. And, inflation's been so low, so long. It's always been the Fed wanted to get to a target of 2%, but that's an average inflation rate of 2%. We don't know how they calculate what an average is. It's been pinned down to zero and almost deflationary for a long period of time.
Yeah, and right now, and one of the other things to remember too is when that happens, the time before a recession usually starts or when they view it, and frankly, the economy and the stock market aren't always, in lockstep with each other. These
That's a
things
good
can
point too.
vary a little bit. And so I think it's more of like taking the big picture and not just saying, well, we got an inversion, you got to get out of the markets. What are we going to do? Because there can be 18, 24 months before a market peaks. There's also, again, we've said this so many times, but we're coming out of this global pandemic that was, once in 100-year sort of event that has just disrupted so much. So yes, inflation's high. It seems like it's going to be here a little bit longer than maybe the Fed first thought going back, a year and a half ago. But we're kind of unwinding everything that's transpired through COVID. And so it's just a different environment. I think it's hard to 100% just take what's happened in the past and say it's going to happen again. It's going to be here. Okay, you're talking about corporations in some of the borrowing versus inflation. The fact that corporations are still, their margins are getting stronger. We've had a nice pullback. Their earnings and their historical prices are more in line is great. You think about the consumer and the individual. You said earlier today, strong balance sheets. I saw a stat today that, and I got to remember where I saw it from. I think I saw it on Twitter. I got to confirm it. But just think about how much, with the rising prices of homes, how much more equity people have and how much their balance sheets have gone up, by owning a home and the prices that we've seen go up. So, I mean, just homeowner equity and ownership is really solid. And for many people, that's their largest asset. Not saying that they're necessarily taking money out of it today, but, I don't see prices in homes, and we've talked about my home search. So I don't see prices for home dropping anytime soon. In fact, I think there's even the case that it's going to stay the same, if not maybe go higher, because I've heard more and more people say, I'm not going to sell my home today. Like, why would I sell my home that I'm borrowing at, high 2%, low 3% to buy a new home, even similar price at 5%,
If
4.5%,
you're in a home
5%. So
now, you're locked in there. You're not going anywhere.
you're not
Right?
moving. So
You're
I
not
think
moving.
the inventory problem is only going to be exacerbated as we move forward because people aren't going to want to sell. Like we may see this, I don't think we're going to see 20% rise year over year, but there's no, just because we have higher rates doesn't mean that these prices are coming down. I think there's a real argument to be made that they're going to, stay high and go a little bit
I,
higher
I
because
I hate to. I want you to be right. I want to push back on you, but I kind of agree with you. I mean, the old adage is real estate's cyclical. Markets,
yeah,
the stock market goes from the bottom left to the top right. It's been doing that for 235 years or whatever, how old this country is. Real estate's cyclical, but man, I hate the equity that I have in my house. I mean, we moved to Saratoga 3.5 years ago. We're up. We could sell for 60% gain in upstate freaking New York. 60% gain. Like, I hate that equity sitting in my house doing nothing. Like, I would almost, I would, this is not financial advice. Please, if you're a client, don't do this. Kind of do a reverse mortgage, take that money out. Let's do something with it, And
well, the time would have been to get the money out
I
3 months
know,
ago. Now
I
with
know.
where rates are, it's crazy. But I just think we're in a different environment. So the point of that was more just you know the individuals in a pretty strong position. Corporations are in pretty good spot. So just because we're seeing this inversion doesn't mean we have to see this immediate turnaround in the markets. And frankly, we usually see the inversion because again it's economic, being in an economic cycle. I mean, the economy hits peaks, it hits troughs. I mean, we are in the economy is naturally cyclical. And so it doesn't mean we're this market's going to go on forever, but just because we're seeing some inversion, you don't have to run for the hills immediately. I think that's
No,
the bigger point, right? Is
no.
again taking a step back and seeing what else is out there.
Exactly. I mean, so the thing that still drives the stock market is, and there's two things I want to bring up on that in terms of funding. I want to talk about the yen real quick. The thing that still drives stock markets, especially now, as interest rates go up and you can start to make a respectable yield. The 2-year notes now paying two and a quarter. Like, I mean, it used to pay like 12 basis points, and 2 years ago they were telling us it was going to be negative. right? So here's S&P 500 earnings per share. So going back to the 90s, making $4 a share, $8 a share, $20 a share. There's the global financial crisis down to minus 23 a share. All of a sudden, look at the earnings that are happening here. $49 a share. So the S&P reports every quarter. How much does the S&P 500 stocks make? 49 bucks a quarter. You can go out to the forward. So look at S&P, I've got it here somewhere, EPS forward. They're looking ahead over the next 2 years, $61 a share. So you're going to go up $11% of 50. So you're talking about 20% earnings growth being priced into the market. That's impressive. And then the other thing, I want to talk about this quick, and I know we got to wrap this up. This brings me back to my days, right, when I was a young, crazy 20-year-old trader in the city, where I was trading downtown for an FX brokerage and hedge fund. 2005, 6, 7, global financial crisis started, and the yen went insane. So basically what's happening, and to give you the background here, is here's the yen against the dollar. I'm going to, for you stock market investors, try to hang on to this. This is really important. This is why, you need to understand what's going on with yields, with fixed income. Why do different maturities and movement in interest rates have an impact on your stock portfolio? It's important. It's, I think fixed income is kind of the most boring stuff out there. Currencies and commodities, equities are more fun, but that's okay. So this is what was happening in 95 up to 97, 98. This is the dollar against the yen. Real quick, what this means is Japan has been suffering from deflation for decades. They've got an aging population. Innovation is still not there, even though they're the third largest economy in the world. What was happening is global hedge fund, macro guys were borrowing yen very cheap. You could get a yen loan for 0.5%, 1%. And then you take that money and go invest in Australia bonds at 5% and make that 4% spread. So that's the yen carry trade. And borrowing cheaply, as Ryan mentioned earlier, it's a little late to refinance and do a reverse mortgage on the house and have some fun with that money. But they were doing that, and that really fueled up into 2000. And the same thing happened again here in 08 right here. And what's happening is the dollar against the yen just broke out of this resistance this month. So the yen is being sold again, and they're fighting all sorts of issues on their end. But hedge funds and global guys are, again, taking yen out of Japan, investing overseas, capturing that yield differential. The point of all that is when hedge fund managers who have, and global wealth and sovereign wealth funds, and all these guys have super long-term time frames, time horizons. When you start to see this happen, they're betting a year, 2, 3 years out. This isn't, a quarter by quarter bet they're looking to make. So coming out of such bearish sentiment reasons, or such negative sentiment that was even worse than the 08 credit crisis right here last month, that's pretty amazing comeback when you combine that with where semis and technology, how they're leading us on the way back. So I'm starting to see signs that we're might be risk on, man, and it might be people were way off base. So sorry to go off. Anything you want to hit on that, or before we sign off, do you want to remind people about some tax deadlines or quarter ending stuff, or what do you want to go with it?
We can hit that. Why don't we hit that in the next few days? I think for now, continue if as we've said before, go to our webpage and sign up for our newsletter, because we're putting stuff. We're sharing the replays of the video. We're also putting out blogs. You touch upon a couple charts each week to kind of give some investors and clients some input into what's happening there. I'm putting out different blogs, so talking about tax, home buying, some planning issues, some behavioral stuff. So whatever it may be you're interested in, you can find it. So go to our website, sign up to our newsletter, send it out about once a week right now. So we're not going to, bomb your inbox. It's going to be, once a week, get good information, stuff you can use. So I think it's important. Yeah,
and I'm happy to say I'm showing you guys how to sign up at newagewealth.com. We have like a 60%. We can show you. Come here, boo boo. It's a perfect time. Come here, AG. My daughter wants to go play. We have like a 60% open rate, which is well above the industry average. So people are opening it, and they're not just spamming it. Come here, EG. It's time to go. My daughter's walking in.
Yeah, she's the boss. I was there the other day. She's the best, and she definitely, I got a daughter to the same age. They run the house.
Yeah, we're potty trained. Let me grab her here real quick. What? Hold on. Come here, yo. Come here, yo. Oh, she just ran away. She's trying to pull me in the basement to go play.
Funny.
All right. Anyways,
All right.
So,
man, well,
good.
this is
Sorry
a
to
good
go
one
an
today.
hour. If you made it this long, we appreciate it. It's just so much to talk about. And check us out. So we're active. We are portfolio managers. We are financial planners. We take a holistic approach. We handle anybody from, we've got clients in their 30s up to their 70s, varying stages of life. If you're interested, jump on the website here and check on work with us if you want to set up a call. Happy to take a look at where you are financially, talk about goals you have, and we can custom fit a solution for you based on what you want to do. Ryan takes care of all the planning, helps with the markets. I focus on the markets. So we're kind of a full service offering. So don't be afraid to reach out, and it's going well. So 6 months in the business, man. Congrats.
All right, partner. Good stuff
All right,
today.
buddy. Yep. Enjoyed it.
We'll talk to all of you soon. Thanks for tuning in as well.
Yeah. Sounds good. We'll see you guys next Thursday. If not, we'll see you on the email list. Have a good night, man.
Perfect.